let me ask each of you to give a minute or so on a key takeaway. Jason, let me start with you, please.
So I think a key takeaway is that we've noted that these regulations are likely not going to be effective until the 2021 tax year for calendar year taxpayers. So there's going to have to be a position taken on a 2018 return, a 2019 return, and a 2020 return. And you're going to have to pick which horse you want to go with. And when the final regulations ultimately come out, you're going to have to go back, revisit those regs, and see if the interpretations you've taken on your returns for those 3 years comply with these final regs, and need to look at whether another method change may be necessary at that point in time.
Topher.
Totally agree. There's so many options on the table here. It would be a mistake to not proactively consider your options here at this juncture. Now that we have proposed regulations, we have 2004-34, we have the statute, everybody needs to be thinking about exactly what they're going to do. The numbers are so big in this space. And then I would also echo the fact that financial statement treatment, more than ever, it's paramount to understand for tax purposes what's happening for financial statement purposes and how amounts are being treated on the financial statements.
Kate?
And I would just say that, we know that the both the -3 and the -8 proposed regulations do not provide for a cost of goods sold offset, but the -8 regulations do provide a carve out for specified goods. The government's received numerous comments asking for a cost of goods sold offset, asking for specified good carve out. And so it's very possible that the final regulations will provide some relief in these areas. I mean, the proposed regulations ask for comments on cost of goods sold, ask for comments related to the specified good carve out. So maybe we'll see an expansion of the definition of specified goods, or perhaps we'll even see a relief in the cost of goods sold area, allowing for that cost of goods sold offset. So I would just say stay tuned and see how the final regulations come out in those areas.
Or comment on one of those areas.
Or comment.
Right? I mean, that's how
right.
it's really, that's how it works.
I mean,
George, you've been there.
asking for it. They're asking for
You have to
comments,
have,
so.
making decisions like this, big decisions like this, in the absence of information is really hard. And so the more people that are willing to comment, the better, I would say.
Yeah.
Yep. And we got a couple minutes here. I'll add in two more other takeaways. One is, I say it over and over, I'll say it one more time. Tax accounting has to link up with financial accounting to understand what's going through that book revenue account. And on your other key takeaway, there's a lot of flexibility here. Kate and I, we were on a call earlier today where a taxpayer wanted a cutoff for their 451 changes because it would somehow impact their BEAT computation, right? You got to think outside the box. And how does all this, if I do a 4-year spread of a big number or do a cutoff and recognize it all, say, in 2018, how does that model out and impact your taxable income, your cash flow, if it has impacts for other tax attributes as well? So like anything else these days, it's a big modeling exercise, but these regulations do have a lot of flexibility in them. Topher, as you mentioned, big numbers here, big accelerations of income.
Huge.
So we're going to have a lot of increases to taxable income over the coming couple of years here with 41A adjustments. Model out whether or not you want current inclusion or whether or not you want that 4-year spread. Most people will default and say, add back to taxable income, of course I want a 4-year spread. But there may be situations where you want to include it all in 1 year. Figure out whether or not you want that, because we do have the ability, I think, to try and get you that position. Jason, Topher, Kate, thank you very much.